Welcome to this explainer. Today, we're going to totally demystify the concept of financing. Whether you're aiming for a major personal milestone or trying to get a brand new business off the ground, financing is literally the engine that makes it happen. So we're going to break down exactly what it means, how it works, and how you can actually use it to hit your goals.
We've got a really clear roadmap for today. We'll start with the basics of financing, then compare debt versus equity, look at sourcing your funds, check out some real-world applications, and finally, wrap up by weighing the risks.
All right, let's jump right into Section 1, the basics of financing. Imagine, just for a second, that you want to buy a house. But, like the vast majority of us out there, you don't have the full purchase price just sitting around in your checking account. This is the fundamental problem we're looking at today. How do you bridge that gap? $300,000. I mean, that is a massive number. For most people, trying to save that up dollar by dollar could quite literally take a lifetime. If we had to wait until we actually had the cold, hard cash in hand, progress would just completely stall. So the solution to that massive hurdle, it's financing. This is the process that allows you to get those necessary funds today. In the case of the house, you get a home loan from a bank and then you just repay it in manageable monthly installments over, a bunch of years. It's basically about pulling your future purchasing power right into the present.
And this really brilliantly illustrates why financing matters so much. It goes way beyond just buying a house. Without it, regular folks just couldn't afford expensive assets like cars or higher education. And businesses? They'd seriously struggle to buy machinery, start operations, or innovate. Because when businesses can finance their growth, they hire more workers, they fund research, and they support overall economic development. It's an absolute game changer for the economy.
Moving right along to Section 2, Debt versus Equity.
So the most crucial point to grasp here is the big dichotomy between debt and equity. These are your two primary levers. Debt financing is exactly what it sounds like. You borrow money and you promise to pay it back over time, almost always with interest. Think bank loans, mortgages, or bonds. Equity financing, on the flip side, is a totally different beast. You aren't borrowing anything. Instead, you're raising money by selling a piece of your business's ownership to investors, like venture capitalists.
The major trade-off with debt really boils down to control versus cost. Look at the advantages here. You get to keep total control and full ownership of your company. Once you pay that lender back, they have absolutely zero claim on your future profits. Plus, sometimes that interest is actually tax-deductible. But the disadvantages are strict. Those monthly payments, they're mandatory. It doesn't matter if you had a terrible month and made exactly zero profit, the bank still expects its check. And if you miss it, your credit score takes a huge hit.
Equity, on the other hand, completely flips that script. The massive advantage here is freedom. Freedom from those strict monthly loan payments and interest charges. Plus, investors often bring incredible expert knowledge and really valuable networking connections to the table. But the cost? Well, it's pretty heavy. You are giving up absolute control. You're handing over a slice of your ownership, your investors will definitely want to say in major decisions, and yep, you have to share your future profits with them.
Okay, Section 3, Sourcing your funds.
You basically have two directions to look here, inward or outward. Internal sources are funds generated from right within the business or from your own personal savings. Maybe that's retained earnings or even selling off some unused equipment. This is fantastic because it generally costs way less, there's no interest, and you aren't giving up any ownership. But when you need a seriously significant injection of cash, internal sources usually just aren't going to cut it. That's exactly when you have to turn to external sources.
If you do go the external route, there's this vast, dynamic ecosystem of funding available to tap into. You've got your traditional commercial banks and credit unions for debt. You've got private investors and venture capital firms for equity. There are even government grants and, for the big players, public share offerings. The options are broad, but they absolutely require you to know exactly what you need the money for.
And this is where things get highly strategic. Duration. You absolutely must match your external funding source to your timeline. Short-term financing, stuff under a year, like a credit card or a bank overdraft, that should really only be used for day-to-day, immediate business expenses. Long-term financing, which spans over a year, like a mortgage or a bond, is what you use to purchase major assets, like buildings, or to fund large-scale expansions. Honestly, a good rule of thumb, never fund a 10-year asset with a 30-day credit card.
Let's see this in action. Section 4, Real-World Applications. Let's really ground these concepts with a couple of real-life examples from our source material. First up, we have Sarah. Sarah really wants to buy a new car, and it costs $30,000.
She has some personal savings, which, remember, is an internal source, and she uses that to put down a $5,000 deposit up front.
But she still needs to bridge that remaining $25,000 gap. So to cover the rest, she uses long-term debt financing. She borrows the $25,000 from a bank and commits to repaying it along with interest over a 5-year period. The takeaway here? She keeps total ownership of her car, but she takes on a very rigid monthly liability.
Now let's look at Ali. Ali is an entrepreneur who needs a whopping $100,000 to open his absolute dream coffee shop. That's a really substantial amount of startup capital. But Ali is cautious, He wants to completely avoid the heavy burden of mandatory monthly loan repayments while he's just trying to get his cafe off the ground.
So instead of going into debt, Ali utilizes equity financing. He secures the $100,000 by finding a private investor. The investor gives him the cash he needs today, totally interest-free, but in exchange, takes 30% ownership of the coffee shop. Ali gets the runway he needs without the monthly stress, but he has permanently given away nearly a third of all his future profits. Which brings us to our final part. Section 5, Weighing the Risks.
It really all comes down to this ultimate trade-off. With debt, you're risking your financial solvency. If your business struggles and you fail to repay, you're looking at severe penalties, ruined credit, or even bankruptcy. Plus, high interest rates can just slowly bleed your cash flow dry. But with equity, you're risking your autonomy. You lose a part of your business, you invite investors in who might strongly disagree with how you run things, and you surrender a permanent slice of all your hard-earned future successes. This source material leaves us with this truly powerful reminder. Understanding financing helps individuals make better financial decisions and helps businesses grow in a sustainable way. Financing isn't just about figuring out a way to grab quick cash. It's a highly strategic tool. When you understand how to balance internal and external sources and exactly when to utilize debt versus equity, it completely empowers you to make decisions that lead to sustainable, long-term growth.
So I want to leave you with this one question to chew on. As you look at your own personal goals, or maybe the big objectives you have for your own business, and as you seriously consider your personal tolerance for risk and control, what kind of financing best suits your next big leap?